Here are the top 10 income investments I covered back in April 2025, which, by the way, was not a normal month. Since then, I've sold these two, and this one slipped outside the top 10. Today, I'll get you up to speed on what's been happening with each of my top 10 holdings. CEFS is yielding just over 8%, and it's a fund of funds, so it offers a lot of diversification. The fund manager, Saba, actively manages over 100 holdings, and looking through some of them, we can see examples of the diversification. Gold and precious metals, technology, credit funds like PIMCO's PDX, convertible bonds, life sciences, muni bonds. It's a colorful fruit salad of income-producing assets. The fund of funds concept is good, but the negative is fees. Saba takes a 1.1% management fee, and each fund within the portfolio has fees built into it. The reason I own this fund and not other funds of funds is that Saba adds more value than just actively managing the 100+ holdings. Saba is also an active investor. That means they take fairly aggressive steps to increase the returns for shareholders, including themselves. For example, they pressured BlackRock to offer investors the full asset value of two of their funds, even though they were trading at a discount to net asset value. Those funds were BMEZ and BIGZ. Looking at total return over the past year, and even though CEFS doesn't compete with the S&P 500, it's been quite competitive for most of that period. More recently, the AI stocks have benefited the S&P 500, but next time there's a tech correction, I think it would favor CEFS on a relative basis. Also worth noting that if CEFS has an unusually profitable year, they pay a special distribution on top of the regular distributions of 14 cents a month. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Number 2 is QQQI, which yields just under 14%. It sells covered calls on the Nasdaq 100 index. On a total return basis, QQQI outperforms the Nasdaq 100 during corrections and slightly underperforms during bullish periods. However, the Nasdaq yields less than 0.5%, so for spending in retirement, you'd need to sell shares and time those sales to avoid selling when the market is down. An important benefit of QQQI and its sister fund, SPYI, is the consistent tax efficiency. An ETF selling index call options can generate income that receives return of capital tax treatment, not to be confused with the return of the investor's principal, which would be a bad thing. I'll include a link in the description that explains the difference between the two. Now, it's not tax-free, but there's no tax due on the return of capital portion unless or until you sell. The return of capital lowers your cost basis, and upon sale, tax is due on the capital gain, and for most investors, that's a lower tax rate than ordinary income. So how much return of capital are we talking about? It's impossible to predict the future, but this 8937 tax form dated May 2025 breaks it down by month in the attachment. Historically, it's been almost 100%. Number 3 is another covered call fund, GPIX. It yields less, 8%. That's partly because it's based on the S&P 500 rather than the Nasdaq 100. This is Goldman Sachs's horse in the covered call index race. With $2 billion of assets under management, it competes with SPYI at almost $6 billion and JEPI at a staggering $40 billion of assets under management. I sold JEPI a while back, and there's not much daylight between GPIX and SPYI. I hold both, but have a larger allocation to GPIX because it has a slightly different option strategy than NEOS uses, less override, and the call options are closer to the money. Now, both of them are good, but given how new these funds are, I wanted to diversify option strategies within my top 10. Also, GPIX has a low expense ratio of 0.29%. Before we get into the fourth holding, I want to thank Seeking Alpha for sponsoring this video. Now, you won't have to fast forward past an ad read because There isn't one. They didn't send me a script. They don't even send me bullet points. Their only request was to share how I use their platform, and I do that in most videos anyway. At number 4, we're going to switch gears from stocks to credit. FSCO yields almost 13% currently, and they're in the lending business. The majority of their portfolio is lending to medium-sized businesses. That part is known as private lending and is similar to business development companies or BDCs. However, they're not a BDC. They're structured as a closed-end fund. This gives them the flexibility to also invest in loans originated by other lenders, also known as public loans. As of Q2 2025, the ratio was 72 to 28, so mostly private loans. But as the economy and interest rates fluctuate, they can alter the mix. The distributions have been solid since it went public in November of 2022. However, the price has been hit twice. First by the tariff chaos in April, then more recently by the First Brands bankruptcy. First Brands was one of FSCO's approximately 77 borrowers, but it represented less than 2% of their loan portfolio when they declared bankruptcy in September of 2025. The scale of the loss was immediately visible on websites including CEF Connect and FSCO's homepage. A chart comparing NAV to price shows a very slight NAV decline in September. In other words, the impact of First Brands was minimal. First Brands announced a lawsuit against its former chief executive and founder, Patrick James. If fraud is proven, it would imply that the loan loss was an isolated event, so I don't see it as a sign of contagion. Number 5, PBDC is currently yielding 10.5%. We're going to cover my favorite BDC in a minute, but if you don't want to select BDCs individually, this fund is an easy way to buy a basket of them. BDCs are private lenders and their borrowers are medium-sized businesses. If we compare PBDC's price to the S&P 500 since the fund was launched in September of 2022, a 19.7% increase looks, well, pretty weak. This price chart came from Yahoo Finance, and it doesn't show the income from either fund, which, by the way, is where most of PBDC's return comes from, the income. A total return chart includes the changes in price and the income paid to shareholders. So let's look at that. And you can see it's much better. The S&P 500, represented here by SPY, pays a yield of just over 1%. So its total return bumps up from 87% to 93%. Meanwhile, PBDC's total return jumps from 19.7% to 62%. The S&P 500 isn't actually a benchmark for a fund of business lenders, but it's still a yardstick that we're all familiar with. I wouldn't expect PBDC to keep up with an index loaded with tech funds, but it actually did do that until recently. The Fed rate cuts and the First Brands bankruptcy soured the market on BDCs, even though none of the funds held by PBDC lent to First Brands. I think BDCs are currently oversold, as I explained in this recent episode. The management fee is 0.75%, but the total expenses look crazy high because the SEC requires that BDC funds count the business expenses of the companies it holds as fund expenses. The confusing expenses and the effect of interest rates on BDCs are covered in this interview I did with the PBDC fund manager, Mike Petro. Before we move on to number 6, let's go back to total return for just a second, and let me show you a shortcut. When you're searching a stock or a fund, just click momentum, then scroll down. It will instantly give you a 1-year total return chart versus the S&P 500. You can change the timeline or add more stocks for comparison. Next up is an individual BDC called Ares Capital, yielding 9.5%. It stands apart from the other BDCs in size, as you can see from this Raymond James report. It's the big daddy. That means it has a more diversified loan portfolio than smaller lenders, which reduces risk. Secondly, ARCC has a consistent payout history going back more than 20 years. And last of all, it's trading at exactly 1 times NAV. As I record this, it was 1.03 times NAV last week when I reviewed it. 1.0 is less expensive than these other high-quality BDCs that I also hold. If you want to see how expensive a BDC is compared to its assets, select charting, then metrics, then valuation, and price to book. I usually delete price return for a simpler chart, then click Update Chart. If we zoom out to the 10-year history by clicking here, it gives you more context. 1.0 is on the low end of where it typically sits. Staying with the 10-year timeline, if we switch to a total return chart, we can see that sometimes ARCC is ahead of the S&P 500 and sometimes it's behind. At the moment, it's behind. If we go all the way back to when ARCC was listed in October of 2004, well, then it's not even close. PFFA is currently yielding just over 9.5%, and it gives me exposure to over 180 preferred stocks. Regular dividends are paid at a company's discretion, but preferred stocks define their payout years in advance. That defined, consistent income stream can be a good fit for retirees, like me. Some preferreds are fixed and some are floating rate. The advantage of a fund like this is that the manager can adjust the mix of fixed to floating based on what's happening with interest rates. If interest rates are falling, then fixed rate preferreds can rise in value. I always get questions about fees for funds like this because they're very confusing. The total expense ratio of 2.52% looks high because leverage funds like this have to show interest as an expense. The actual management fee is 0.8%. You can buy an ETF that passively tracks the preferred stock index and pay a lower fee. PFF, which competes with it, only charges 0.45%. But PFFA's active management has easily outperformed PFF, so I don't think the tiny savings in fees is really a saving. Number 8, JBBB yields 7.6% and holds just one type of credit, collateralized loan obligations or CLOs. These are pools of business loans and should not be confused with CDOs, which are generally much riskier. CDOs can hold home loans, whereas CLOs are strictly business loans. 7.6% is at the lower end of the yield range I'm looking for, but it offers the benefit of low volatility compared to stocks. During a correction, this gives you the option to sell it and buy something else that's been hit harder. Important to note that the loans are floating rate, so the income will move in the same direction as the Fed funds rate. If the Fed continues to cut rates, I'll probably phase out of this one. Number 9, we're almost there. The BlackRock Science and Technology Trust, with a ticker of BST, is an actively managed closed-end fund that currently yields about 7%. This is another one that's below my typical 8 to 12% range. The yield has fallen because the price has gone up so much. Over the past year, it's actually ahead of the S&P 500. So this low yield is a good problem. I'm tempted to take some profits, but on a price to NAV basis, it's still fairly well priced at a 6.4% discount to NAV. The top holdings look like most tech funds, but what makes BST different is they also hold some private placements. For example, Anduril, the defense contractor that makes cutting-edge drones, revenue is reportedly over $1 billion, but you can't get much financial information or buy shares from your brokerage because it's a private company. This is a way to dip your beak. BST's income has been consistent, and occasionally they've paid huge special dividends. They sell options on a small percentage of the portfolio, so this one isn't as income-focused as most of my portfolio. It requires patience because the big payoffs occur when those private placements go public or they get acquired. Over the past 5 years, the performance has been pretty dull, other than this year, but over the past 10 years, it's been spectacular. Last but not least is EICC, which yields 7.9% and is a preferred stock. Earlier, I mentioned the PFFA fund holding 180 preferred shares. EICC doesn't offer that diversification. It's just one company, Eagle Point. I bought this one for the low volatility. This is how it behaved during the April tariff correction. It didn't even blink. This company manages CLO funds that pay much higher yields and are quite volatile, or risky, I guess you could say. Holding the preferreds insulates you from the ups and downs of the CLO market because as a preferred shareholder, you get paid first. The income is simply $2 a year divided into monthly payments of just under 17 cents. What about UTG and WDI? The utility fund UTG is still one of my favorites, but the price went too high and the yield went too low. So I swapped it for its competitor, UTF. WDI is a credit fund that contains a blend of high-yield corporate bonds, CLOs, and loans. I still like this one too, but I sold it when the discount to NAV shrank. More importantly, the discount to NAV has become attractive again. So it's on my watch list to buy back again, potentially in the near term. WDI is currently yielding a juicy 12.5%, and if you want to learn more about it, Kane Lee prepared an excellent analysis on Seeking Alpha. It explains how WDI will benefit if interest rates continue to fall. I'll include a link to Kane's article in the description and a link for a free trial and a discount. I don't buy or sell any income investments without first checking Seeking Alpha. I'm on there pretty much every day. And if you're watching this before December 9th, 2025, then Seeking Alpha is running its annual Black Friday sale. The link in the description will give you the details on the Black Friday deal or the Armchair discount, whichever is applicable when you're watching this episode. Okay, so these are my top 10 largest holdings, but they top out at a maximum allocation of just over 5%. I don't consider holding these 10 to offer enough diversification by themselves, so I hold more than 30 different investments in total to spread the risk. Also, the 8 to 12% range I mentioned at the beginning is the strike zone for my portfolio. We saw that some of the larger holdings yield less than 8%. To balance that, some of the smaller holdings that we didn't cover today, like BTCI, pay more than 12%. The S&P 500 appeared frequently as a reference in the charts today because we're all so familiar with it, but it's not a benchmark that I use for my portfolio. The S&P 500 will outperform my portfolio during bull markets. However, it doesn't provide much income, and as a retiree, consistent income is what I'm optimizing for. I don't like to sell shares to pay for my bills. I can't update these videos when I make changes to my portfolio, so I send out any changes monthly via Armchair Insider. The total return charts and distribution charts I use today are handy for comparing income investments, and they're not on Yahoo Finance. You can learn more about how I use these tools in this video. It's called 4 Tools for Income Investing. That wraps it up for this top 10 update. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.